Hello folks, welcome to a new video. As promised, in this video we are going to be blending the round numbers and the average daily range in order to just combine them to get the ultimate profit taking strategy. Okay, as far as intraday trading goes. As we've already established on the previous two videos, round numbers and the average daily range are two unique and, well, fantastic tools in order to pinpoint, in order to map the intraday trading price action, right? Well, we are now going to blend them again in order to designate our ideal profit-taking levels. Okay, here's how we are going to do it. Alright, well, let's assume we are trading the euro against the American dollar. I have placed some hypothetical round numbers here for the euro against American dollar: 145.00, 145.50, 146.00, 146.50, 147.00, etc., etc. Okay, and well, let's assume the day starts in there. All right. Price is moving just as usual. We break the 145.0050 and we find right there our system triggers a buy entry at that level. Okay, at that precise junction of the chart, as the 146.50 as price breaks just above the 145.50, let's assume our system gives us a buy entry. Well, now we are obviously to locate our stop loss and our profit taking levels. I'm not going to get into the stop loss placement because either I'm going to get into the entry on how to actually trigger the entry. That's going to come for a future video, but I'm going to be talking especially about the profit taking strategy. So again, we take our entry right there. Where do we place our targets? Well, I usually like to conduct a multi-level price targeting strategy, right? I basically like to not to exit my trade in just one go. I like to actually place multiple profit-taking levels just to be unloading, different portions of the trade as well as the trade moves in my favor, as the trade moves in my direction, just to make sure that I lock some profits out of the market, okay, and I cash out some portions of the trade, again, as the trade moves in my direction. So, assuming I get my entry there, always I like to place my first portion of the trade. Let's assume a 33% of the trade just prior hitting the next round number. In this case, 5 pips before hitting the next round number. In this case, that would be 145.95. Again, 5 pips before hitting the round number immediately above my entry point. Again, just to secure a little bit of the profits. All right. That would be my entry. That would be my first level where I would exit 33% of the trade. All right. If price comes to touch this level, all right, again 149.95. At least I make some money right off the bat. 33% of the trade, I close it out, leaving obviously a 64% of the trade running. But at least on that 33%, I have already, 67%. My maths were, out of place there. Anyway, at least on that initial 33% of the trade, I have already made some money. That usually takes off a little bit of the pressure in the trade, okay, just to cash out some profits as soon as possible. Then I would obviously calculate, as I take my entry, I would calculate the ATR projection, just as usual, okay. Let's assume adding the average true range to the low of for the day, it takes me all the way here, somewhere in there. All right. Well, then I would let obviously the remaining 67% of the trade run to further profits somewhere in this area. Okay. So what I usually like to do is every 50 pips, every round number, I like to unload an extra 33% of the trade all the way until my until my ADR projection. All right, 33% of the trade would go there, and at this time I have 34% of the trade remaining. Now, what I will do, obviously, is to close the final portion of the trade in the round number immediately before hitting my average true range projection. Let's assume the average true range takes me all the way to 147, I don't know, 17. All right. What's the round number immediately before hitting my average true range projection? Obviously, it's 147. So I would indeed close out the final 34% of the trade there. All right. Let me clean up my screen for a second. All right. Well, let's review another example. Okay. Price is moving on its merry way. Breaches above the 145.50. Our system gives us our entry right there. Okay, let's assume 5 pips above the 145.50, meaning 145.55. Right there, we get our buy entry. Well, then as usual, the first thing I like to do is to calculate my average daily range projection. But instead of taking me all the way up there, well, let's assume it takes me all the way up here to, well, 146, I don't know, 70, for example. All right? Well, if you look at the chart, you will find that we only have 2 round numbers in between my entry level and my average daily range projection, right? Before we had 3, that's why I exited 33% at each round number. Well, this time around we only have 2. So instead of exiting at 5 pips before hitting the round number immediately above my buy level, in this case that would be 145.95, instead of exiting 33% of the trade, well, this time around I'm gonna be exiting 50% of the trade. All right, 50% on the first round number, the remaining 50% of the trade at the second round number. Again, because we only have 2 between my my entry point and my average daily range. All right. Maybe you may be asking, what does exiting 50% of the trade mean? Well, that means that if you took the entry with 4 lots, all right, well, then you exit 2 lots here and then 2 lots there. You don't want to stretch your targets all the way until the very average daily range in itself, just in case today we fell shy few pips from the actual average daily range. All right. Please mind that the average daily range, as already established on a previous video, basically pinpoints exhaustion levels from a statistical point of view. So you don't really want to stretch your final target all the way right to the pip, to the exhaustion point, okay, to the very exhaustion point, right to the pip. You don't want to do that, just in case, again, some days a currency pair just falls shy of the actual average daily range for just few pips, and well, you don't want to take that risk. That's why what you want to do is to simply, close out the trade as a whole on the previous round number. In this case, again, 50% on each consecutive round numbers. So, okay, what do we achieve by blending the round numbers and the average daily range? Why do I say that it's the ultimate profit-taking strategy from an intraday point of view? Well, first of all, we are always trading within the statistical averages. Okay, so we are putting statistics on our end. Again, the average daily range keeps tracks of statistical moves, right? So we are by making sure that we set our profit-taking level, our final profit-taking level, just before hitting the average daily range. Well, we make sure that we are always trading within what's statistically possible. All right, so we are putting the odds on our favor, okay? And then by blending that statistical average with the round numbers, what we are doing is offsetting the risk on this trade progressively as the trade evolves or develops in our favor. Okay, please mind that round numbers are intraday pivot points, intraday levels of support and resistance. So the more levels of, imagine we were going long, we found a buy entry. Well, the more levels of intraday resistance that price needs to break through, well, the more and more chances we are gonna have that eventually, sooner or later, these round numbers or price will not be able to break through, and eventually, it always happens, guys, sooner or later, price always is bound to lose momentum. Well, we might eventually get a reversal, okay, not really a breakout, but actually a bounce of those round numbers. And the best way to offset the risk is just by actually closing out progressively, again, as price develops in our favor, portions of the trade along the way. Obviously, you want to close them just before 5 pips, usually is enough, 5-6 pips is usually enough before hitting that resistance level, okay? Well, resistance, if we were going long, if we found our entry there and we were going short, well, these levels work as support, okay? So what you want to do, 5 pips before hitting that level, you want to close a portion of the trade just in case we actually get a bounce. At least, if you get a bounce, you know that at least just before that happens, you've already made some pips, you've already made some money, you've already cashed out a portion of the profits out of the market, okay? And those pips that you've already cashed out, they are in your pocket, they are in your account, and no one can take them away from you, okay? So again, by blending round numbers and the average daily range, we trade within the statistics and we offset the risk as the trade progressively offset the risk as the trade develops or moves along in our direction. I've been using this strategy for years, okay? Whenever I am intraday trading, I've used this strategy for, I don't know, hundreds of trades. And it's always worked pretty nice for me, okay? Trust me if I say that round numbers and average daily range is all you need in order to set your profit-taking levels from an intraday point of view. Obviously, this strategy doesn't quite work whenever you are trading on the longer time frames, all right, such as the 4 hours, the daily time frame. Please remember that the setup chart, the bread and butter, the main time frame of reference for intraday traders is either the 1 hour time frame or the 30 minutes time frame. Whenever you are finding trading opportunities in these time frames, you don't need nothing else but actually round numbers and the average daily range, okay? That's all you need in order to set your final profit taking levels.